Welcome back to another episode of the Meet Kevin Show. It's been a while since we've done one of these, but today we have none other than the famous Ross Gerber from Gerber Kawasaki and ticker symbol GK. And boy, do we have a lot to talk about from markets. Crazy capitulation happening today. Huge down day. Tesla hit 10, 11% down, for example. NASDAQ down nearly 4%. Scary day, a lot of fear, and it's all just 3 days away from Christmas. So ho, 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 and welcome, Ross Gerber.
Yeah, can you believe Jerome Powell killing another Christmas? He did this to us in 2018. This guy is like, he makes the Grinch look like a great guy, you know? It's like his job to force the U.S. economy into a recession and destroy people's Christmases. And it's two of the last 5 years we've had bear markets, and this one's severe because of Jerome Powell. And it's almost like, it's like the point of America is not to make money now. You know, it's like, we don't want people to make money. They did too well. You know, we gotta bring everybody down 25%. And that's basically what's happened. You know, we've got, 4 to 5% interest rates, and everybody's lost 25% of their value. And, there's a lot of stress and tension about it, which is certainly reasonable, but there's a reality that we just all have to face with 4 and 5% interest rates, that the value of our assets are less, and it sucks.
Yeah, I mean, it seems like Jerome Powell really is focused on this rear view mirror mentality too. I mean, why is everybody talking about Q3 GDP? Who cares that Q3 was stronger? All the companies in their earnings calls were complaining, saying that things were changing in October, not Q3. Nobody cares about Q3. We care about Q4 and what's going to happen next quarter. But it seems like Jerome Powell is sort of legislating, if you will, off of the past. What's your take on that?
Well, totally. I mean, they're a completely reactive Fed. They were slow to react when inflation had risen in last November. They should have started raising rates, good 3 or 4 months before they did. And because of that, they jammed rates down our throat and had to talk rates up, and now they're looking at data that's so old. Now, I don't think that the Fed doesn't see what we see. I mean, they have to read the Wall Street Journal and see the layoffs and see, especially like housing, for example, which I'm sure we'll talk about today.
Oh, yeah.
I have a lot of clients in real estate, and I'm on the board of another real estate company that's in commercial and residential. And it's just like dead. Like, it's just like everything's stopped. Now, a lot of people think like once the new year comes, people will kind of come to terms that rates aren't going down. And if you want to buy anything, you're going to have to do something, but prices are going to have to come down to offset these rates. And people who live in, most of the United States are going to lose 25% of the value of their home, thanks to Jerome Powell. And I say thanks to Jerome Powell because I think rates are unnecessarily high to achieve the same goals he could achieve with lower rates.
Yeah, no kidding. It does seem like it's gone a little overboard. I was looking at inflation break-evens, and we're kind of sitting at where we were in 2018, but then I compared to 2018, and the Fed funds rate then was 2.5%. Now we're at what, 4.25%, and they're trying to hike us up to 5.25%, all while the indicators are pointing down, not up. It just seems overdone. Like this Fed forced recession is honestly going to make them turn the money printers on again. What's your take on that? Is that possible? Could they have?
Well, and that's the whole point. The whole point is like, why do we have to have an economy that's fundamentally based around the Fed stimulating it versus just letting some inflation run? Like, for example, who said 2% inflation should be the goal? Because ever since I started in the industry, we were running inflation numbers at 3%. Or actually, when I started, we were running inflation numbers at 5%. And then we lowered inflation. Like when you retire in 20 or 30 years, what's the cost of living going to be? And so when you start thinking like, okay, I'm 40 years old, I want to retire at 70, so 30 years of inflation. Well, the difference between 2% inflation and 3% inflation is a lot. Okay. But the difference between 2% growth and 3% growth is a lot too. And if you're trying to build wealth, you want more growth, but you want to keep inflation within a range. But the fact that the Fed is so focused on a inflation rate that's so low that it implies that there's almost no growth in the economy, that's what's most troubling, because it essentially says that the only economy they see is one that they have to stimulate because they make it so slow.
that's
versus
interesting.
a
It's
higher
almost like,
inflationary economy.
yeah, I mean, it almost seems like we're in a place where we're always going to be in a world where the Fed is either overstimulating or over tightening.
Right.
Can we just live in a world that actually operates like normal? It seems like they're actually making booms and busts worse when the purpose is to make them less bad. They seem to be making them worse.
Well, if you look at the long-term trend of like the way the Fed has acted since inflation was crazy in the 70s, you see this just still this gradual, as they would raise, it was never as high. As they would lower, it would get worse. And then when the financial crisis happened, that was the moral hazard of when the Fed really said, now I'm going to start controlling the economy. We'll raise rates, lower rates to zero. We'll print money. We'll buy bonds. And it was the same thing they did during the pandemic, which they support asset values, which certainly helped during the pandemic. But they got to a point where it's like the only economy that people seem to think exists is one that's stimulated through Fed action, which has also led to the extremely negative sentiment that if the Fed doesn't do this, then we'll never have a good economy without it, which is also incorrect. So the real question is, the Fed or me or you have no idea where rates should really be, right? Like, should it be, is the Fed right? Should they go to 5? Or should they have stopped at 3.5? Nobody really knows, because we're not going to know for another 6 months, okay, what the real rate should have been. But if you look at the actual 2-year note, it's still sitting around 4.24. And so that's what the 2-year saying. The 10-year is telling you 3.6, so in my mind, the Fed's gone far enough. That's what the market's saying. Yeah. So any further increases, and that's really what's hurting the market, is any further increases from the Fed just further exacerbate the recession we're going to have next year.
Now, something that I think is interesting is I was running through the scenario in my mind, and I wanted your take on this. I mean, we'll see what ends up happening. But when stocks do end up recovering, it does seem like people would be more inclined again to maybe move from cash over to stocks. And if people sell bonds to move into stocks, then we would see the value of those bonds come down. And even as the stock market rises, is it possible that we could actually see bond yields rise? And the whole reason for mentioning that is it then possible that as the stock market rises, mortgage rates actually either stabilize high or potentially rise a little bit and continue to hurt real estate while the stock market actually starts recovering?
I don't see that as much. What I see is that, like, a 10-year rate, which really functions around mortgages, it's really thinking like, what's inflation over the next 10 years? And I got to be a little bit above it. So the bond's saying right now, inflation is going to be, let's say 3.3, 3.4 over the next decade. And I'm a little bit above it. So if I buy a 10-year, I'm going to come out ahead. Okay. Right. So that's a pretty elevated level of inflation still by my mind. And it's certainly, the Fed has made it clear they don't think that's acceptable. Okay. So if that's the case, then mortgage rates will probably be lower, based off the fact that when the economy really slows, people will be buying bonds. Okay. So what will happen is the Fed will be done at some point in Q1, probably, when they see all the data finally that they've killed the economy. And then it's like, they're going to keep rates higher. And so that means the long bond will actually probably still be inverted until the Fed actually starts lowering. Okay. So this set of scenarios is what the market really doesn't like. It really doesn't like the idea of the Fed having to hold rates at, let's say, 5%, while the bonds are saying we don't need this. And it's essentially you're just driving down the economy. And so investors will continue to buy longer term bonds the longer they hold the short rate high, because it's more likely we're going to have a slower economy and lower inflation.
Right.
So that then it would be the opposite. So let's say the Fed said, I went too far and I'm lowering 50 basis points next meeting. Okay. We'd all cheer. The markets would cheer, but then you'd have the bond sell off because we'd have growth. Then yields maybe are, and then it's like, so, that scenario is 0%. So now.
So what you're saying is the market might be more interested in focusing on, are we recession, bond yields up? Are we growth, bond yields down?
Right.
In that case,
bond yields down means will grow, and bond yields up mean bad.
so another thing, speaking of growth, I was comparing, I looked at Nike's earnings and I saw that, in the prior 2 quarters, they had negative year-over-year earnings. In this last quarter, everybody got so excited because their year-over-year earnings, Ross, this is a big number, okay? Diluted year-over-year earnings grew by 2%.
Right.
Okay. And that's Nike. And they're selling for somewhere around 28, 29 times their earnings, 18 months out. And Tesla right now is selling for less than that, somewhere around 24, 25 times earnings, 18 months out, 12 months out. And yet Tesla's growing earnings at 35 to 50%. What's going on with Tesla?
It's funny because the people in my office are like, all you do is talk about Tesla. I go, that's what everybody wants to talk about. Yeah, you want to talk about MGM? I'm super bullish on MGM. It's my number 2 position. Nobody wants to talk about Vegas. Nobody wants to talk about Formula One. I'm sorry. I'm not talking about Tesla today. And then everybody throws rocks at me. No, look, you guys have seen what's going on. You can't be everything to all people. And Elon's stretched himself far enough here. And the stock sales have been super dilutive. Like any way you look at it, he's sold $40 billion worth of stock in the last year. And if you think about individuals coming up with 40 billion to buy this stock from Elon so he could buy Twitter, that's a heck of a lot of cash. So if you're wondering why Tesla stock is down, it's because you have a major seller and that same person isn't convinced anybody to be a buyer. In fact, what he's done is he's convinced many people not to be buyers. And what a lot of people perceive now is he maybe convinced a lot of people not to be buyers of the car, which I don't necessarily believe, but I think, how would I say this? I think sometimes we try to do things and it doesn't work quite how we want them to be. And Elon, I think, is starting to take the right steps to find a CEO for Twitter and get back to Tesla as soon as possible so that the focus can be back on what's important, which is launching the Cybertruck this year, scaling production at their factories. And if we say earnings estimates are between $6 and $7 a share, they have to achieve that. You see what I'm saying? And so if they achieve that and Elon's focused, we're looking at a $300 stock. Okay. It's an incredible buy if they make their numbers this year.
Right.
Okay. But to do that, I think 100% Elon needs to be focused on Tesla. That's just what I think. That's my opinion. Elon might not agree with my opinion either, but that's my opinion. Just the same, I think Twitter needs a media CEO and it's not really the best thing for him. And so I've worked really hard over the last week to try to convince him and people that, he can do a good job at Twitter and just not be CEO, And I think you tweeted my favorite tweet of the day yesterday, which was, I'm not CEO anymore. I'm head of software and services, which is basically CEO, which is true. But it's all about optics. You see what I'm saying? True. It's all about optics. And so I think there'll be a big general sigh of relief when Elon moves back to Austin again.
Yeah, no kidding. I think it's really what you said about the order book, about Elon having gone through $40 billion of selling, which is, not volume, right? And I think people confuse that. And I'd love for you to comment on that for a moment. People usually hear, he sold 40 bill. Oh, the volume will absorb that in a couple days. But that's not true because really this is 40 billion of held shares, not traded shares, that now have to be offset by another 40 billion of held shares. And the reality is, in the last, I think last week, Vandetrack did a report that retail only bought 650 million of Tesla in a 5-day period. So that takes you 61 5-day periods just to offset his selling.
Yeah. Yeah. And that was sort of like when we were having, he's like, securities analysis 101. And I was like, I got to the page on dilution and I was like, here we go.
So tell us about that. He yelled at you. He kind of, he snapped back at you and said something.
I said I was going to run, I took a Kevin Pathrath playbook and I said I was going to run for governor, which is Tesla board of directors. And of course, when I first said it, I don't think he really perceived that that was a potential. But then when I tweeted again, basically like, this sucks, like just totally absent, like board doesn't even say anything. Like they don't do anything, like the Tesla board, they could be nobody and nobody would even know the difference. Right. And then, so Elon didn't like that I said it was time for a shakeup. And he was like, well, what do you recommend, Ross? So I put up my 3-point plan, which is, essentially we need to know what's going on with you and what, what the next move is. And we need to know, we need you to say that you're going to stop selling stock. I mean, what institution is going to buy $1 billion of Tesla stock right now, knowing that Elon could just dump it on them, right? And so, we need a standstill agreement and we need a secession plan. One of my favorite investors died today. This guy, Scott Minerd. Scott Minerd runs the Guggenheim Fund that we have a lot of money in, the Guggenheim Bond Fund. GIBIX is the symbol, GIBIX. I've met him many times, and Guggenheim's down the street from here, and he was a pure bond guy, and I'm a pure stock guy. So I used to love, his take because it was always negative to the stock market. So it was like, I always like those views that are most negative because I want it, especially from really smart guys, because I want to like debunk it or understand it or whatever you want to say. So Scott was a bodybuilder and he was massive and he used steroids, which unfortunately led to his demise, it seems. He died of a heart attack working out. And he's young. Relatively
60 something. Yeah. 62 maybe. I think.
Yeah. We say that's young.
Yeah.
But this is why you have secession plans, because the first thing is I got to see how much money I got at Guggenheim, but it's money. But they have a team that runs this money, but Scott's the brains behind this whole thing.
Yeah.
Guggenheim's super good. But now I got to look into like, what's next with this fund? Are we going to liquidate our positions in this fund? Like, what's the secession plan? So asking for a secession plan, it's a normal part of business. Asking for some sort of detailed plan of what Elon's roles will be over the next 6 months is not an outrageous ask. And asking for a commitment for transparency about stock sales is also not an outrageous ask. And if I can't get any information from these people, I'm going to continue to press to run for the board, because communication is the key for successful companies. And when companies aren't communicating well with shareholders and customers, you get a lot of dissonance. And that's where Tesla is right now.
Yeah, no kidding. It seems like that transparency is really important. But then again, I suppose if you have this really long view, maybe it just creates this nasty void where, anybody who's on margin or loses faith because of this political drama leaves, and it creates a nice buying opportunity if you have cash left. Interestingly, I think there's a chance that in this Fed-induced recession, you could see companies like GM and Ford cut back a lot on EV production, because those are money-losing vehicles for them, right? Ford loses money on their Mach-E. So in a recession, you're trying to preserve cash, so you want to produce less money losers. So
I've seen them actually idle the ICE plants is what they've done.
So I'm wondering, though, in a recession, could it potentially be that they hit the gas a little less on EV? And we'll see what you think, because we know that's what Toyota's doing, right? Toyota and the head over there, Toyota.
I mean, they're anti-EV,
really the hybrids, right? Yeah. But what's your take on Tesla maybe taking more market share during a recession?
I think any company that pulls back from their EV business like Ford, it would be a huge disaster, because people love the Ford EVs. Okay, so my basic premise is still, I don't think Tesla's having any problem selling EVs personally. They're discounting EVs because of all this nonsense from the government. So the government, the Biden administration has really not served people well from a lot of things they promised. And one of them is this EV tax credit. So starting January 1st, there's supposed to be an EV tax credit for Tesla for $7,500. This is what's causing all of this. So if I'm about to buy a Tesla, why would I buy a Tesla today when I could wait 2 weeks and get $7,500? So the government was supposed to release last week and this week, like, what are the rules, who qualifies, so that consumers would know. And they punted it for another 3 months. So now they're saying we're going to give a broad idea of who would qualify, but we're not going to say till March. Now this screws Tesla, okay? Because it's just like people put off, it's $7,500. It's a legitimate amount of money. So Tesla then discounts to say, well, it's a tax credit for $7,500, but I'll give you $4,000 off now to buy the car, because essentially you would otherwise save more, but you'd have to wait. You know what I mean? And so this discounting is smart because Tesla's cost of production has gone down. So we've seen commodities spiking, and Tesla raised prices last year several times, and now commodities prices have dropped. And so Tesla has bigger margins, and now they're able to just throw these discounts out left and right to try to goose sales now that it's like super confusing for consumers of what to do around the end of the year. So it's a little bit frustrating that the government can't seem to be honest and clear with who qualifies for what incentives, and it affects Tesla.
That's odd. I'm just looking at that now. It's here's Reuters, just on the 19th here. Revamped $7,500 EV tax credit taking effect Jan 1. Treasury Department said it will delay until March its release of the proposed guidance on the required sourcing of EV batteries. The announcement means some EVs that will not meet the new requirements may have a brief window of eligibility in 23 before battery rules take effect. So I'm not exactly clear. Does that mean
nobody knows?
Nobody knows.
This is the point. This is the point. So it was like, well, you're supposed to, according to the law, you get the $7,500 on January 1st if the car qualifies. Right. But they're supposed to have released who qualified. Now, by my math, Tesla qualifies. But it's like this totally arbitrary set of like numbers, like 40% of the batteries from here, the assemblies from here, blah, blah, blah. You know, so the government made it super complicated, and nobody likes it other than Tesla, really, because they're the only ones who really do everything, most things here in the United States. That said, it confuses consumers because the $7,500 is real. And when I bought my first Tesla, I got that $7,500 off, and that's real, you know? So I paid $60,000 for my Tesla Model 3, I think it was, and I got $7,500 back. And the state of California back then was giving $2,500 as well, which I didn't qualify for. So you were getting $10,000 back in California buying a Tesla. And so, you know, that puts some pressure on the stock short term, but it's such a short term issue that ultimately ends up with Tesla winning anyways. I just think right now for investors, if you have the ability to, you know, you're not leveraged and you have capital, this is a very unique opportunity, because I don't necessarily think the recession is going to be that bad. And I don't necessarily think earnings are even going to be hit that hard, because nobody's factoring in the fact that we're going to get margin expansion across multiple industries because of the lower cost of input. You know, like China is a mess today, but once they get out of this COVID mess in 3 months, they're going to be like America last year when everybody's going shopping crazy. Wow. And they're all going to go to Macau, and hopefully they're all going to gamble in Macau and bring back, you know, that business, because they were invested in MGM, and they're going to go to Shanghai Disneyland. And I think there will be an economic boost from China next year that a lot of people aren't factoring in, because they finally got rid of zero COVID. So I have 3 points to my bull market plan. The first point is the Fed has to stop raising rates. The second point is China had to get rid of zero COVID. And the third point is some sort of ending of the war. And so we've got one of those points down now. So now I only have 2 points, and the Fed's got to end soon. And they just have to. I mean, even if they go to 5%, they still end in Q1, you know? And then the war in Ukraine can't go on forever. So Putin's kind of bluffing, saying he wants to go for the long war. But if you remember how the Cold War ended, well, you were kind of young. Well, the Cold War ended because Russia and the United States were in this spending race for nuclear weapons. And eventually Russia ran out of money before we did. And that's what's happening right now. So Russia can continue to spend tons of money on their military, but they're going to run out of money, and they're going to run out of people. And that's what's happening now. So I think for investors, it certainly sucks that the Fed has gone out of their way to ruin another Christmas. But if you can sort of keep focused and buy these stocks here in small amounts, as I've been recommending for the whole year, and staying conservative still, as we get through Q1, I think this opportunity passes, and the markets have got a bottom in here somewhere, and rates have got a top somewhere here. And then we've got to find this sort of base, and then we have this opportunity for markets to start to move again into a new bull phase. But boy, you know, they've made it super tough on investors.
Yeah, no kidding. Oh, that's really interesting. Now, I mean, yesterday Ukraine just got funded with another 45 plus $2.2 billion. It doesn't. I mean, that's certainly going to keep Ukraine going for a while. And I think they realize this is probably it, because next year, honestly, for the next 2 years, we're going to have a lame duck Congress, or maybe not a lame duck, but a stalemated Congress that probably won't be too enthused to provide a lot more funding to Ukraine. So they've got to stretch this. I imagine Ukraine is well aware of that. But is it possible that Ukraine runs out of money if that U.S. money stops and then Russia does, prevail?
Well, we're not going to stop. We're not going to stop. And, Ukraine has become the 52nd state of the United States in a way. Look at it this way. If you want to destroy your adversary, Putin, it's a lot better for America that this is happening in Ukraine versus U.S. soldiers being involved in U.S. kids dying in this war. So, the Ukrainians have suffered greatly fighting this war. So the fact that we can only just give money and arms is a huge plus, because they're destroying our adversary. Yeah. They're destroying Putin's army. And what they've done is they've done a wonderful advertisement for the U.S. military industrial complex, because our weapons are clearly the best. We have such a superiority in military defense. It's unbelievable. And we've added to that in our fund in GK. So Northrop and we've recently added Raytheon, but the military defense sector is going to have a renaissance over the next 5 years between all the spending. I mean, Japan just said they're going to spend $50 billion a year. So the budget for Ukraine's military defense that we've given them is about half the size of the entire Russian military budget for the entire country of Russia. So we've essentially given Ukraine and the Europeans almost an equivalent spending on military equipment and personnel as Russia has completely. So this is real bad for Russia, and it's real good for America. So this war is real good for America. And Russia clearly is probably the worst. Putin, it's just the worst government in the world. And the people are hostages to this. And so destroying Putin and their current government is a wonderful U.S. goal. And if we succeed, the world will be in a fantastic place moving forward.
You see Russia, or in other words, this war with Russia, because obviously in the short term, it's created a substantial amount of suffering here because of high oil prices, gas prices, European potential recession.
Yeah, that's nonsense. But suffering is sitting in a ditch in the snow with your kids murdered, fighting for your life. Okay, Americans, we have not suffered at all. We've had higher prices, and we have a strategic petroleum reserve. Gas prices are back to normal. Look, Americans have to understand sacrifice, and the sacrifice that Ukrainians are making today is immense. And we have nothing to complain about, just that we had a little bit of inflation or whatever. That's gone. But people are dying every day.
Long term, this is actually better for everyone. That Russia gets weakened is what you're saying. And that's
not just weakened, but Ukraine stays free. And the West, the idea of democracy, remember a few years ago, it was looking dark. We had dictators in America and Russia and China and Brazil and dictator Trump, dictator. That was in. We don't want that. We want democracy. Okay. And I'm not saying this from a partisan perspective. We want a democracy. If Republicans win, fine, but we want a democracy, and so having democratic governments like in Ukraine, creating a system where Ukraine becomes more part of Europe, the West, is a huge power move, for the West, and so the rebuilding of Ukraine will be an enormous economic boom. Remember, Japan and Germany were destroyed post World War II and became some of the strongest economies in the world, thanks to, I think it was the Bretton Woods Agreement, when the United States and Europe helped rebuild Germany and Japan and built them into economic powerhouses. Ukraine could become an economic powerhouse in the global economy. They have wonderful resources and can totally supplant Russia's place in the world. But eliminating a massive nuclear threat that's a constant destabilization from Western democracy is a massive victory for America. Massive. So we haven't done that yet, but so
that's why you think
support this.
Don't worry, the funding's not going away for Ukraine. Even Republicans, even a divided Congress will provide something to make sure.
Remember who the Republicans like to support? Defense companies. So the budget was raised for defense well above what Biden wanted, actually, because of the Republicans. The Republicans added to defense. So the Republicans don't, they might say this or say that. That's based off their constituency. They just want more money spent on defense, and they've won, and they'll use Ukraine as a reason to spend more money on defense, whether they care about Ukraine or not.
Wow.
And that's why you got to invest in defense contractors right now, because we're in a cycle now where it's clear to me that a ton of money in Europe, Japan, in the United States needs to be spent on defense, not just for the future, but to replenish what we've used.
That's it. Yeah, that's really incredible, because you're really saying we could now have a powerhouse of an ally in Ukraine, and now all of a sudden we're actually really boxing in Russia and China.
Right.
And interesting. Yeah.
And what does she do? He goes to Europe. He has a little talk with some people, gets rid of zero COVID. His economy's bankrupt because of these policies. So he needs to get the economy of China going. He's in no position to attack Taiwan. It's like the most important thing she does is get his economy going before his entire system falls apart. So
no kidding.
So we've got our enemies at bay right now. And if it weren't for the Fed putting us at risk of a severe recession, America could be in such a driver's seat over the next 5-10 years in the global economy and the global power structure. It's like, wow, that makes me wildly bullish.
Yeah.
Once we can get through these two other issues, which is the Fed and Ukraine, so I don't know how long that's going to be. And, I'm buying bonds until it's over.
Yeah. Well, speaking of buying
bonds. By the
bonds,
way, I know House Hack is the best performing investment I have for the last 60 days.
So tell us a little bit about House Hack. You're on the board of House Hack. There's a website people can go to read the solicitation, househack.com. It's my real estate startup, which you're a board member of. Tell me about this.
Right. So let's start with the disclaimer. This is for accredited investors, right? And so House Hack is a real estate investment that Kevin has started, that I've decided to be a part of, because I think it's a very, very good time for investors to start looking at renting residential real estate or owning rental residential real estate. And because I don't expect, a massive decline in real estate prices, but I expect a pretty decent decline in real estate, that there's this opportunity out there. And so Kevin has raised money to do this. I've invested in House Hack as well. I offered to be a board member for several reasons. One, Kevin's younger and very ambitious, so I figured working together would blend both of our skill sets in a very complementary way. So we have different experiences and background. I know very little actually about real estate, but I know a lot about finance. And so it was really a great opportunity for me, to learn from Kevin, and also Kevin to learn from me. So that was why I wanted to be involved. Also, the issue of credibility. Kevin's a YouTuber and he's building a huge future for himself and company. And I'm very much a supporter and believer in that. And I think as he's moved from just being sort of a YouTuber into a real financial business, he wants to learn and associate himself and do things the right way. And it's hard if you've never been in this industry to know, like, how do I handle all these different things? And if you just pay consultants, it's not helpful. So by working together, it really he gets this like tons of experience that I've had, and help him build his financial businesses and do it in a way that creates transparency and trust, so that investors don't have to go through what they've been going through in the crypto industry. And that is super important to Kevin. And that's something I wanted to really express to people, that you really do care about transparency and trust. And that's why I was willing, there's a risk me doing these things with you. And I was like, this guy really wants to do things the right way. And you started by making the right decision of moving House Hack's assets from the bank into an account that's managed by me at Gerber Kawasaki. And by doing that, there's a third party, and our assets are held at LPL Financial, so that there's third parties holding your assets if you're an investor in House Hack until these assets are deployed. And after our strategic discussion, we decided that the best thing we could do for House Hack shareholders is to buy short-term treasury bonds, because we felt not only was it actually a really prudent thing to do with the money because we could earn over 4%, but actually opportunistically, because we both felt interest rates were high, that we could actually even possibly make some capital gains. And I'm actually proud to say that the house hack has a capital gain now in our bond portfolio of about $30,000 because of the timing of the purchases. And so actually the rates have gone down a little bit since we bought. And so the bond yields have gone up. So we've picked up about a 1%. No, it's a small percent of gain, but it's a gain.
But on the monthly, I think we're looking at a gross yield of something, like 70, 80K or something like that on a month. It's crazy. And we're doing nothing right now, just waiting to buy real estate. It's great.
Yeah, we got Jerome paying our bills. It's thank you, U.S. taxpayers, for giving us such a high rate of interest that we don't have to do anything and still make money, right? And that's kind of the whole point, is it's like, money sits on the sidelines until rates go back down, and then we buy real estate, So house hack is, I think, for investors who want diversification and want to create ideal an income flow and some capital gains, house hack is going to be an opportunity for people to take advantage of what we are looking to buy, which is mostly single family residences that you call them, what do you call these things? Wedge deals. Maybe you can explain a little bit, like, what is a wedge deal exactly?
Yeah, great. So the reason I call the deals that I like looking for wedge deals is because I'm looking for something that I could buy in a $500,000 neighborhood that I could pick up from a seller who has to sell because they got wrecked, a tenant got evicted, or they lost money in crypto,
or their mortgage expired and they can't afford the new mortgage.
Exactly. They just got to get out. They need the money for some reason, and they have a fixer-upper. And you walk into this thing and it smells like, nasty, it's moldy, it's got problems, defects, whatever, right? And so my goal is to try to go into a $500,000 neighborhood and buy homes for $375,000, $350,000, knowing that I only need to put $25,000 or $50,000 into them to make them safe and quality rentals. I don't like low quality rentals. I renovate every single rental I touch, so they're my standard and they're quality, because that's how you attract good tenants. But now what you've done is you've actually bought a place for $375,000, say, plus $50,000. You're into a deal for $425,000, which is below the median home price in America, in a neighborhood that's a great neighborhood with great resale comps all around the values of, let's say, 5. Now you've created a $75,000 to maybe $100,000 wedge, depending on how much you spent and what kind of deal you got. And that wedge is really just extra equity. So we took basically $400,000 of capital, $425,000 of capital in an example, and turned it into 5 with no market movements at all. Now, if the market moves down, we have an insulative blanket. If it goes up, the blanket gets bigger.
So you're taking two elements. Part of it is the opportunistic element of it, and then part of it is the time and the fixer-up effort to add value in the purchase, so that then you gain value on the real estate, but also a higher rent that you would associate with that better property.
Yeah, and I'm trying to get somewhere between $3 to $4 per dollar that I spend in renovation as the wedge, right? So this is where you get the homeowner that walks into, like, and this exact thing happened to me in 2018. I walk into a property with these clients, these home buyers. It's a $650,000 property, and I'm like, this place is worth $800,000 all day long. So you go in, and it's just, some of the blinds are broken. The carpet's dirty. The kitchen has an old color of wood, but it's a 2003 built home or whatever it was. So it was only a 15-year-old-ish old home. And I walk in with the home buyers, and they look and go, oh my gosh, this entire place needs to be gutted. We need to spend $150,000 on it. That's what home buyers think. Remember, in single family, you're competing with home buyers. They don't know anything about market values. They don't understand investing. So they told me, we don't want to buy the home. I said, okay, no problem. I ended up buying the home. I spent $20,000 fixing it up, got it appraised for $150,000 more.
Totally.
My 20 turned into 150.
Yeah, no, it's totally like my house that I just bought. It's the same thing. It's like, it's a fixer upper. I've lived here for years, and my landlord finally panicked and sold it to me. But if I I'm about to put some money into it, but I'll make 3 times what I invest because the guy never put $1 into this place.
Yep.
And it's just like a win. And I'm like, dude, like, I'm going to make good money investing in my own home. And that's, I think, what you're trying to do on a smaller scale, because obviously Palisades is a little bit pricey to do wedge deals.
Sure.
But and the market's pretty tough here. Actually, it has not gone down here. That's for sure. There's no supply. But I think when you look at markets, like what markets do you like the most?
Yeah, let's hit that. Let me also just quickly say there's a
because like Austin's
from,
coming down quick, and I like Texas a lot.
Yeah, quick answer here for Hector. Hector's asking when can non-accredited investors invest? So we just completed, just an update for everybody. And also for you, Ross, Bob just finished with the auditing firm, our SEC audit. So our audit is 100% done. And now it gets signed off over the next few days and goes to our Reg A attorney. She then puts everything into a package, submits it to the SEC, say first week of January, the SEC has it. We'll hear back from the SEC by my birthday around the end of January. We'll probably go back and forth for a month or two. And we think by March, you will no longer have to be an accredited investor and you could potentially invest in house hack, but not just yet. So Ross, to answer your question about locations, what's interesting is you do have some really neat opportunities already. When you look at home price declines, you can look in Texas, for example, and you could see in some areas like Austin, prices have already come down as much as 18% from their peak.
Because when we were there,
Idaho,
it
right?
seems so expensive.
Yeah, it's all really come down.
Yeah,
so the problem is we don't know how long the pain is going to go. We just know that the pain is still happening, right?
It's just starting.
Pain is still happening. It just started. So there's no rush to declare, okay, for sure we're going to invest in this area, because we want to declare where we want to invest, ideally roughly when the bottom's hitting for that real estate market. How do you know? Well, usually you tell when you get closer to a bottom, when you see a really sudden and substantial absorption of inventory below trend, and at the same time rates are level or falling.
Right.
And then when you pick up the phone, this is the most important thing. People are so afraid of meeting people in person. And this is what I'm going to be doing. I'm going to be traveling all of 2023, meeting real estate agents around the country in person to find these areas. But people are afraid of this. But this is how you know the bottom is. You get on the phone, and right now you call an agent in Austin. Hey, how many offers you get? Dude, man, I haven't even had a showing in 3 weeks, right? Closer to the bottom. What does it look like? Hey, I saw you had a place that went up for sale. It's been on the market for 3 days. Just wondering, do you have any offers? I can't believe it. All of a sudden, out of nowhere, we got 13 offers. We're going X thousand over list. That's when okay, that at the same time as inventory is turning in an area that was the opposite. When you get that change, that's when you know
it's
you're
same in the stock market, right? Like volume, you get a bottoming price, you get an increase in volume, you get rates.
You might know that better than me.
It's the same idea. It's the same idea. But I had a great meeting yesterday with a real estate client of mine who's been doing it for probably 50, 60 years. He's an old guy. And we were talking about the market. He's a builder, so he knows lots and lots of people. And we were talking about the market, and he's like, I've been doing this 60 years, and we're just beginning the decline because it's such a slow process. Because there's been so few transactions, you don't even see the decline in pricing at all yet, because the sales have just dropped and dropped and dropped. So they're saying it's like basically like the pandemic right now, that like there's so few sales. And so you don't actually see the comps. This is like the Fed, oh, well, inflation hasn't gone down because I haven't seen the lagging indicator yet. You know what I mean?
Right. But we know it's down.
But it's down. So if you look at, and every market is different, so you have to put that out there. But if you look at what's going to happen with real estate, especially if the Fed keeps rates higher for longer, as these mortgages mature and as people need to move, or as people lose their jobs and can't afford their homes anymore, they're going to have to sell, and they're going to have to sell into a tough market, which brings down prices, lower and lower. So one might say it might be a year till we really see a good opportunity in real estate.
Potentially. Yeah.
And so the best part is, in the meantime, we make good money because the Fed has raised rates too far.
Exactly.
It's a crazy thing, like the Fed is paying us to wait for them to knock down real estate enough for us to then buy. And then people are pissed about wealth inequality, rightfully.
Yeah.
Because of the policies that the Democrats and the Fed have put into place. Like, what do you want people to do? Not take advantage of the fact that the Fed is sinking the housing market. Well, I'm
And I
sorry.
hate
What
to
do you
say
want
it,
me to
but
do? I've been trying to stop this for a long time, but I'm certainly not going to buy houses cheap if they're cheap.
yeah, yeah. It's sad because the last people to benefit in an economic bull run are poor people. They're the
Right.
last ones to win. The first ones to start winning are people with assets,
Right.
real estate, stocks to be the primary two, obviously, followed by bonds.
Right. And see, this is what exacerbates wealth inequality is the Fed. It's
Yeah.
the Fed. And it's
Yep.
crazy. And it's crazy. So it's like they make houses unaffordable to people, so that like people can't afford houses. Then they create layoffs that like they're saying it. They don't want wage growth. Okay. Like the markets are getting hammered today. Why? Why? Because the economy hasn't died.
Q3 GDP
Yeah,
coming in
because
higher.
the economy hasn't died. I'm losing my ass because the economy hasn't died. The Fed is literally telling poor people that have finally made some more money, who finally seeing rising wages, that we're going to stop this right now. We will not let you not be poor. That's what they're saying. But when the financial crisis happened, there was this thing called Occupy Wall Street, and they had the pictures of Bernanke and all these people up with like X's over it and whatever, because everybody knows why there's so much wealth inequality. It's called look at Donald Trump's tax returns.
Yeah.
Okay.
Yeah.
I pay way more taxes than Donald Trump, and you do too.
I paid more than him in his disclosures the last 4 or 5 years. I paid more than that last year.
That's right. That's right. And I'm close. And I'm like, dude, our system is so rigged against the average American, and the Democrats take over. I'm a Dem. I vote for all the Dems. You think this is going to stop? No, they make it worse. They make it worse.
Crazy.
And so I'm super frustrated right now. And people are like, oh, you're mad because your stock portfolio is down. I'm like, no, I'm going to buy all my stocks next quarter, and I'm going to make a ton of money on the next cycle. I have liquidity. I'm not leveraged. Okay. But what makes me sad is all the people we work with who are trying to build wealth and get jobs and buy houses and get ahead. Americans want to get ahead, and the Fed's just constantly knocking you down. And the old politicians that control our society only benefit the old, just like this new retirement plan thing where they give tons of benefit to me because I'm over 50 and they gave no benefits to you at all. Okay. And so it's like we've created a system that's like so rigged for the old wealthy people who actually see running our country. You know, it's just totally rigged to those people. And everybody else are just held down by the Fed, by taxation policies, by BS real estate laws, whatever you want to say. And it's super frustrating to see this whole cycle happen again, right as the economy is finally growing and people are finally getting wage growth.
Yep. Nailed it. Yeah, it's crazy. So what's, for 2023, you going to come travel with me? Are we going to go visit people in person? Would that be cool?
Well, there's nothing I like more than to travel around talking to real estate agents and stuff, but that's not quite my job. But I will certainly visit. Yeah, my goal with House Hack and my other real estate ventures is actually to learn, because I'm a stock guy, and I've been a stock guy my whole life, and I've worked with real estate people my whole career because they wanted to diversify, and I've spent some time learning. But I hate, how I started our relationship was that I hate real estate, and I still hate it. It's still just as horrible. But I've realized a lot over the years that, I kind of started in, the first real estate boom, before the financial crisis, like learning how to lose money in real estate. And then I've made good money in REITs over the years, in the stock market. But what I realized is that the fundamental basis for wealth, a lot of it does revolve around real estate. And it's a great thing to understand. So that's really my goal, is to learn from you and my other real estate, company I'm involved with a lot more, because I want to be able to provide my clients a broader series of advices in areas that I'm not an expert in, that I'm learning on. So it's also the fun of my job. Like, I like learning and there's so much to commercial real estate, for example, that I just don't know.
It's endless.
So I'm excited for that. But my main goal actually for 23 for me is my company's growing very rapidly, despite market declines. The demand for financial planning and services is enormous. And we have, 27 advisors. Our accounting business has grown to 5 accountants now as well. Our accounting business is booming. So
let me get this straight.
This is a busy time.
At Gerber Kawasaki, you have financial advisors, accountants, you have an ETF that you actively manage with your firm. You're a licensed financial advisor. It's like, this is a lot of stuff. How do you deal with all that?
We have an insurance company too.
Insurance. How do you deal with all this? And I mean, it sounds great for people. It's like a one-stop shop, what you've created.
Sort of. Yeah, we do a lot of things, not everything, but remember, it's all around a client relationship. That's where it starts, so our goal is to get families and individuals, put them in improve their financial situation. And that's really crucial in times like this, what we call asset allocation, making sure you're not taking too much risk. So, we've lost a bunch of money this year, but because the general focus of our firm is conservative, nobody's losing all their money and all that kind of stuff. It's just like, we have to bounce back next year, So building a financial plan is one of the key things we do. And then we provide those services. So we've always managed our portfolios by hand. So the ETF was just an extension. It was a way for us to scale our business, because the investment management for now we have 11,000 plus clients is super hard. And so by having an investment product, it allowed us to give our clients GK stock picks, but in a much simpler manner than trying to manually buy and sell stocks for now 19,000 accounts, which is just not possible. Right. So that was actually meant for an efficiency. And that has worked. Insurance and accounting are different divisions run by different people at my company. And so when you come in as a client, we work as a team. So you're simply referred to those experts within our company so that you can get the services that you need. The reason we provide those services is, especially like accounting, is we found that most accountants were extremely difficult to deal with and ended up causing us a lot of wasted time. So we were wasting more time dealing with other people's bad accountants. So we were like, maybe we should just do this ourselves. And at first, it was not easy. Our first year was quite painful, but then we found the right team, and it's just taken off since then. And what we found was there's just tremendous demand from people for a good accountant that's reasonably priced.
Yeah,
and so
there is.
Because we already do your financial services, we were able to price our accounting services at a very competitive rate, and we already have everything for you. So it's super convenient. We know your whole financial situation, and we added all this technology that a lot of accounting firms don't use because we started from scratch. So once we have your information in our system now, this year, for example, we're going to be able to, provide people their taxes for them in advance and be like, what's different? Send us your W-2s and what's different. So we're trying to make accounting and taxes the easiest possible for clients. So really for us, it actually improves efficiency providing these services versus using outside people from our clients, which ended up wasting a lot of our advisors' time with bad tax returns and back and forth and wrong information. It's just bringing it in-house, increased efficiency and increased results for our clients. So also taking advantage of all the tax advantages,
can you explain that? I don't think people fully understand the idea of the tax advantages of an ETF, like the rebalancing benefits that you get. And it is, nobody teaches that, right? I mean, tell me from your POV.
I mean, this is part of the reason you started PP2, right? It's a tax shelter that most people don't realize. So I've been putting all my money into my ETF, and I can't believe it's like $15 this morning. I was like, this is incredible, because the entire way up on the next cycle, I won't produce a capital gain.
Bingo.
And this is the amazing thing.
Yeah.
ETFs have this real estate tax advantage that only exists in ETFs. And it's very similar to a 1031 exchange. And a 1031 exchange allows you to move your basis or your investment from an appreciated asset to a new asset without having to pay taxes. And you can do that in an ETF. So let's say we buy tons of Tesla and it goes up. It's a dream. And it goes up and we double our money and we want to take profits. Well, instead of selling and paying a capital gain, you can do what's called a custom basket. And basically you just move your Tesla stock for a basket of other stocks and there's no tax consequence. Really, Vanguard got this law passed for rebalancing the S&P and stuff because they didn't want to have tax consequences on all their rebalancing. But when active ETFs were created, they didn't realize that traders like me could take advantage of this tax advantage. And that's why I started the ETF. It certainly wasn't timing. That certainly wasn't good. But the tax advantages have now multiplied because we started at the top of the market. Now we have embedded $10 of basically free capital gains before I even have to even worry about any capital gains. Like, it's crazy. So like you can only put X amount in your IRA and your 401k, but you could put $1 million in either of our funds right now and not have a capital gain spit out on the entire next market cycle.
That's actually really interesting because what you're saying is Vanguard helped either lobby or whatever to get this change, but that's because they're worried maybe that, oh, well, the allocation to Apple is 1.61.
Right.
It needs to be 1.6. So they sell that little, 1 basis point or whatever. That in theory would pass on a capital gain. So they created this loophole to solve that so that it's just an exchange. There is no capital gain. Now, because active management is popular, somebody could go from, 20% Tesla, it rallies to 40%. Okay, you drop it to 10%, basket change, no capital gains is what you're saying.
Yeah.
It's crazy.
And so that's what I've been doing with my own money is I've just been like buying my ETF every week, shifting assets into it, especially now that it's cheap, because it's essentially like an IRA in a lot of ways, not every way, but in certain ways. And on the last cycle, last year, I paid so much in capital gains taxes. It was insane.
Yeah.
And so if you look at your portfolio in a typical year, you would have maybe 3 to 5% of your return eliminated from taxes, Now, in years like this, where you lose money and now you can harvest taxes, tax loss harvest, you get a double advantage because then you can embed these losses that you harvest, then put your money in an ETF that doesn't even produce capital gains. Oh my God, what a great opportunity. And that's why I say it's time to meet with a financial advisor. That's what we do at Gerber Kawasaki. If you're a house hack investor or you want to invest, we got to get a PP on LPL somehow. But if you want, ideally, if you want to invest and really get a good financial plan built, that's kind of the secret of what we do. Okay. There's investment management, which is like, I want to build a stock portfolio, or I can just buy the S&P. And then there's financial planning, and that's tax advantages and using the plans. For example, your 401k plan. For example, the Roth IRA. I was talking to a young person online yesterday about the Roth IRA, and they were like, oh, this and that. I go, the Roth IRA has been around since 1998. Okay. And if you started, I remember, and it was like $2,000 you could do in a Roth, and we were throwing parties when this thing was invented. And boy, you've been able to build an enormous amount of tax-free wealth. Do you realize that the Roth IRA, you don't qualify for it if you make a lot of income, but if you don't make a lot of income and you qualify for Roth, now you also qualify for a Roth 401k no matter what your income level is. And figuring out how much money to put in these retirement plans is one of the keys to your future, because they've changed the law now to be up to 75 before you have to take money out of your IRA.
Right.
So it's all tax deferred. So if you build your financial plan right, you're avoiding paying taxes on your gains by investing in real estate, IRA accounts, ETFs outside your IRA, for example, Roth IRA, municipal bonds, tax-free.
And that's what you guys help do.
That's what we do, is we help you build this portfolio. But by doing it in a tax efficient way, we increase your returns by a substantial amount over time just by being tax efficient. And that's one of the reasons we added accounting to our firm. And that's one of the reasons you should be working with us, because we can look at all the stocks we want, or we can buy the S&P, or we can buy our ETFs. That's not really the game. The game is building a financial plan that's going to work when the market goes down. We have a lot of stressed clients and clients that are frustrated to lose value, including myself. But we built financial plans for people, so that they're going to get through this. And we just have to constantly remind our clients to think ahead 6 months to a year. We're going to make back our money. Things will get better. This is a really bad year, but you have a financial plan that you're not losing your house. You're not losing your retirement, and in fact, if you're saving for goals and you're 30 years old, this is exactly what you want, to be honest.
Yeah. Yeah. Okay. Last question I have for you, Ross. And then we got to run. So some folks are under this impression, and I want your confirmation that I took all our house hack money and bought a jet. Did I take the house hack money from your fund?
I told you not to buy a jet. This is your own fault. It's your own fault. You rent jets, okay? When you buy a jet, see, you didn't call your financial advisor. See, this is what Kevin does when he doesn't want to hear no. Okay. This is what he does. He doesn't call his financial advisor. No, listen, I've had clients buy jets and they eventually sell jets because they're very expensive to maintain and you can rent them. Okay. And it's the same tax deduction, whatever. But the problem when you buy a jet is the optics. This is what I've been trying to teach Elon. It's like, it's not really what you do, it's how it's perceived, and so you can say I'm buying a jet to fly around and do business, which is true. Okay. Because the truth is commercial air flight is the most inefficient way to do anything. So it's real hard to run a business if you got to jump from city to city and you got to fly commercial, good luck with that. They cancel half the flights, right? So, but one of the reasons that you moved the house hack money to be managed by me was so that there wouldn't be this bull crap.
Yep.
Okay. So I can safely say I looked at the account this morning. I'm happy to post its values if you wanted me to. And it's held by LPL Financial as our custodian. It's a third-party custodian. It's $21,500,000, I think, that we have in there. And hopefully the new capital that we raise will continue to flow in so that investors know that Kevin, who makes a lot of money personally, bought his own jet. Okay. And that's when you see what the FTX fraud, and I certainly get people's reticence. And I unfortunately was growing my career in a period of time with the Madoff fraud, and it sucked. It sucked because there's this distrust that it's exacerbated, and people should have this distrust anyways to make sure they're doing the right thing. But I think when you're young and you're on YouTube and you're trying to build an investment business, you have these certain challenges. And that's one of the reasons I think working together has a value for both of us. Because I think one of the reasons GK uses a third-party custodian as well is to build confidence with our clients. LPL is one of the top holdings actually in my fund as well, because it's such a well-run business. The people who run LPL are great, and we've worked with them now for over a decade, and they run a solid business, and that's where your assets are. So, I think it would be fair to say, for me, there's no reason why House Act isn't 100% transparent with its assets. And it's held by third parties. And this is what FTX couldn't do. They would say, oh, we hold our assets, then we transfer them to Alameda, and then we trade your assets. Like, for example, we could have taken your money and traded stocks with this, but we're not going to do that.
Right. Okay.
We're not doing that at all. The mandate was we can only buy treasury bonds. That's all we wanted to. And now it's the best performing account I've got in the last awesome, 60 days. Right? Yeah. We're up. We're up in this market, great.
Well, for what it's worth, I'll keep it mostly on the note of house hack. What I think is really interesting about it is, I signed for this plane myself. It's my liability. It's a personal liability, but it's basically a free option for house hack, right? I mean, there's no liability for house hack. I'm taking all the risk of it with my YouTube business, right? So it's actually really cool. So I'm very, very excited about that.
Yeah. Well, listen, you're one of the hardest working people I know. So let's start there. There's no magic here with me, Kevin. Okay. This is one of the hardest working people. And quite frankly, you've inspired me in a lot of ways. You definitely inspired me to run for the Tesla board of directors. That was definitely inspired by me, Kevin.
Nice. No way.
Oh, for sure. For sure. After you ran for governor, I was like,
if this guy
you got to just do stuff sometimes, who cares whether I win or lose? It's like, you got to just do it. Once again, I'm a big fan and I love the work you do. And I know you have lots of people who rely on you, and you, I think you try very hard to give people the best information possible. And I think, you deserve the success that you've had. And I think that you're a prudent person underlying. So, congratulations on your success, on YouTube. And for a lot of people who, like my kids, want to be YouTubers, and I said, I might go up and visit Meet Kevin. If you guys want to come, you can see what a real YouTuber does. And if you really want to spend a day with a YouTuber, it starts at like 4:30 in the morning when he starts his shtick and editing and this and that. And it probably ends at who knows what time at night, and so your success is warranted. I hope you enjoy your jet, and I know you're going to use it for business, because you don't do that many things for pleasure, to be honest. And no, I mean, you do. You work a lot. Yeah. You work a lot. And thanks, so look, I'm excited to work with you on House Hack, on our ETFs, helping your viewers with their financial planning at Gerber Kawasaki. This relationship, I know we have lots of your viewers as clients, and we really appreciate your viewership and your support at my firm, and the people who we work with, who are Meet Kevin people, really love you and the show and such. So it's been a great opportunity for both of us, I think. But I'm really looking forward to the future. Like that's what kind of keeps me going in these like tough markets, when you kind of get down on yourself a little bit, and it's super hard not to get down on yourself when you're losing lots of money every day, and it's kind of like for no reason, because the economy's strong. You got to focus on the future, and that's what I think is so hard for people and investing, is we have this recency bias, and then we're super beat up from losing so much money over the last year. And then we're not looking forward and saying, hey, this is creating life-changing opportunities for people who play this right. So it might take some time for that to play out, but it takes these extreme periods of time to create life-changing opportunities for investors. So you've got to keep liquidity and stay in the game, but I'm very excited for 2023 and where that will lead us over the next 5 years moving forward. Whether it be Tesla, whether it be House Hack, whether it be PP or GK or whatever. It's a great opportunity for people who want to build their future to work with our teams and really get ahead. So, it's a really unique time and a tough time, but will ultimately lead to, I think, a great future.
I agree. Russ, how do people reach out to you at your firm?
I mean, you can go to our website, gerberkawasaki.com, or reach out to us. Info at Gerber Kawasaki. Certainly you can follow me on Twitter at gerberkawasaki.com. We work really hard at our firm. I have great advisors at my firm. They care so much. They work so hard. It's crazy. And I think it's a great opportunity because we have no minimums. We're the only firm you can go to that's a big firm that doesn't say no to people. And it's a huge opportunity for young people. That's really who I want. I want young clients who want to get ahead. People like your age who are saying, hey, I'm 30 years old and I want to get ahead. I want to live in the Palisades like Ross when I'm 50 like Ross. Well, you got to start when you're 30. I started when I was in my 13 and really started investing at 23. And so there were lots of ups and downs over the last 30 years, but you'll end up in the right place if you start young and build a good financial plan. And that's what I'm here to do. And my firm is here to do. And I've got some great people you can work with. So reach out.
Amazing. Well, yeah. Ross, thanks so much for coming on the show. Folks, check out gerberkawasaki.com or Ross's ETF or ticker symbol GK. And hey, share the video if you found it helpful. We'll see you in the next one. Goodbye.
Yeah, thanks, Kevin.